everyone, welcome back to the second episode of our Contra investing series, where we analyze businesses that have corrected a lot and identify if the correction creates an opportunity or not. Interestingly, some of these businesses are quietly getting accumulated by smart money and retail shareholding is reducing. In case you are new to this series, so far we have covered the introduction video on Contra investing, where we discuss the framework to identify if the company falls into Contra approach or not. And then in the first episode, we discussed the fundamentals of Sona BLW. In today's video, I'd like to discuss Indian textile companies that have major business from US. I'm sure you would be aware that since the beginning of Trump tariff saga in April this year, US focused textile stocks of India have seen a sharp beating. So in today's video, we'll deep dive into three companies. Gokaldas Export that corrected more than 45% from the peak of 1250 in December 24 to 670. However, there has been a strong recovery and stock is at around 900 level, still much below its all-time high. Second is Indo Industry that corrected around 50% from the peak of 420 in December 24 to around 210 level. It also had a strong recovery but overall well below its all-time high. Third is Pearl Global Industry that also corrected around 45% from January high. But the stock has recovered significantly from the lows and showing huge strength even during this difficult phase. Just to inform you that we have discussed Gokaldas and Indo in the past as well. But Pearl Global is the recent addition in my tracking list. Alright, let's put these three companies in our 4-point Contra investing framework and identify if they qualify as Contra bet or not. In the first part of our framework, we check is the business fundamentally strong or not. Here we look at three things: business model, management quality and balance sheet. Let's go one by one. So if you look at business model, Gokaldas is one of India's largest apparel manufacturers. It specializes in high quality garments for global brands. One of its key strengths is strong integration across value chain, right from design, development, cutting, printing, all the way to finishing and logistics. In the last 3 years, Gokaldas has grown aggressively because global brands started shifting sourcing away from China. Second, Indo on the other side is a global leader in bed linen exports. Company also entered into new businesses of utility bedding and brand business by acquiring a 180-year-old company as well as some licensed tie-ups. Their new business contribution has jumped from 2% to 12% in 2.5 years. Third, Pearl Global is an apparel manufacturer with manufacturing facilities across India, Bangladesh, Vietnam, Indonesia and Guatemala with a mix of in-house and partnership model. Here Bangladesh has the highest capacity. In fact, the very reason why Pearl Global has recovered sharply after tariff fall is because of its multi-country manufacturing facility. Second, if you look at management quality, Gokaldas Export is run by a professional team under the leadership of Mr. Siva Ramakrishnan Ganpati, who has 3 decades of experience. In fact, Gokaldas has transformed under his leadership from losses in 2017-18 all the way to very high profitability. Indo has been run by one of the most experienced team in home textile with decades of specialization in the bed linen category. Pearl Global is also run by a highly experienced management team that has built manufacturing across multiple geographies, something that only the top 1% of Indian apparel companies have achieved. One thing that is common among the management quality of all three companies is proper communication with transparency. Every issue is clearly discussed with the stakeholder in the con call. If you check promoter shareholding, Gokaldas promoter holding is reducing, but that's because its promoter is an investment firm, not individuals or family. But it is the FIs and DIs that are buying and weak hands of public have reduced consistently. Although since Trump tariff saga, public holding has slightly increased. Indo promoter holds significant stake and have not sold any stake in last 12 quarters. Public holding has again consistently reduced in last 12 quarters. DIs have consistently increased stake. Pearl Global promoters also hold high stakes. They did reduce some holding, but it is completely absorbed by FIs and DIs, mainly DIs, and public holding has kept on reducing. Then if you look at the balance sheet, Gokaldas debt to equity is under control. Cash from operating activity has increased except for 2024 where it is negative due to high inventory and receivable. Cash conversion cycle is decent for apparel manufacturing company. Margin profile again look healthy for an apparel manufacturer. Indo also has comfortable debt to equity. Cash from operation is very good, although the cash conversion cycle is a little long. Margins are in double digit, but there is a sharp fall since 2024 highs. Pearl Global debt to equity is also decent. Cash from operation is good. Cash conversion cycle is excellent. Margins although are in single digit. Overall, I don't see any red flag in balance sheet. Yes, the balance sheet is not extraordinary, but that's because of the capex heavy nature of textile sector. Considering that, these three companies are doing great. So on first criteria, all three companies are fundamentally strong. Now let's look at second criteria. So next criteria is, are the current issues temporary or permanent? So if you look at the latest numbers, Gokaldas has managed to grow at decent rate in trailing 12 month, but company has posted weak Q2 numbers. Indo trailing 12 month revenue growth is still decent at 11%, but its profits have fallen drastically. Pearl Global has managed to grow at excellent rate due to its multi-country manufacturing capability. The biggest reason for latest underperformance for these textile companies is US tariff issue. Earlier this year, Mr. Trump increased the tariff on India from 10% to 25% and later increased it to 50%. This is by far the biggest reason behind sharp correction in US focused textile companies. So what has happened is, textile companies have absorbed some part of the tariff and remaining is passed on to the brand. For instance, out of 50%, Gokaldas has absorbed 15% and with remaining 35% is shared with brand and the supplier. The biggest problem is India's textile competitors, Bangladesh and Vietnam have 20% tariff. So the delta of 30% is massive. Obviously, it is unsustainable. In fact, Gokaldas management in the con call clearly said that at 50% tariff, there is practically no business possible. But it seems this 50% tariff is just a tactical pressure from Trump. There will eventually be a deal. In fact, there are strong rumors that India and US are close to trade deal. As a result, all textile stocks have already jumped 35 to 40% from the lows. Even the management of these textile companies clarified that the assumption is that tariff thing is not going to last long. That's where these textile companies have sacrificed some margin to hold their market share. Likewise, Indo has also done the same thing. So going forward, if India-US trade deal takes a longer time, it will have a big negative impact on Q3 performance as well. And market sentiments can remain subdued, further impacting the share price. However, if the deal happens, it would create a big positive sentiment and these textile companies can see strong re-rating. Another risk with Indian textile sector is intense competition from low-cost textile manufacturers in China, Bangladesh and Vietnam. While this is a structural problem, top textile companies like Gokaldas, Indo, Pearl Global are successfully competing and have managed to grow very well. Also, US retailers do not want dependency only on China. That's where India is one of the beneficiaries of this diversification beyond China. Apart from this, textile companies also face raw material volatility issue. So when cotton prices goes up, it impacts the margin. But this is a cyclical issue, not structural. Next criteria is the long-term demand story intact or not. So as far as long-term demand is concerned, the global apparel industry is valued at $575 billion in 25 and projected to reach $715 billion by 2030. So the demand is not explosive, but there are certain structural changes happening in the textile industry. The biggest change is supply chain diversification, or you can call it China plus one. Traditional manufacturing hubs like China and Vietnam are facing rising labor cost. And India offers labor which is lower as compared to China and Vietnam. But Bangladesh has even cheaper labor than India. Although Bangladesh has its own geopolitical instability. That's where India is well positioned as a preferred sourcing destination. We are a stable economy and we have got a cheap labor. So the leading Indian textile companies are expanding their business with both greenfield and brownfield capacity addition across India, Bangladesh and other countries, as well as strategic acquisition. For example, Gokaldas has 150 crore of capex planned in FY26. It also acquired Dubai-based Atraco Group for $55 million, giving it access to low-cost, duty-free manufacturing location. Pearl Global has 250 crore of capex planned in FY26. That includes 110 crore capex in Bangladesh. Indo has 214 crore of capex planned. Even when earnings were under pressure, all three companies kept adding capacity or acquiring new asset. That is the biggest indicator that long-term export demand is intact. Because no textile management invests hundreds of crores unless global brands have already signaled multi-year order pipeline. On top of this, I don't know how many of you are aware, but India has made a great FTA, that is free trade agreement deal with UK. This will make 99% of Indian export to the UK duty-free, including textile. Before this deal, many Indian textile products faced 8 to 12% import duty in the UK. With duties gone, Indian exporters will be much more price competitive versus countries like Bangladesh, Vietnam and China in the UK. This will likely improve margin significantly for apparel, home textile and other textile category. Now let's look at the final criteria. Now let's come to the most important question of contra investing. Have valuation meaningfully corrected to compensate for the long-term problems or not? Are these stocks now available at a point where risk rewards are favorable? So first of all, P/E ratio won't show you the right picture at the moment because the margins have fallen, that has resulted in sharp fall in EPS. So P/E would show inflated. That's where it's better to look at price to sale. So Gokaldas price to sale touched peak of 2.9 last year. Since then, it has fallen to current levels of 1.7, which is near its historical 5-year median as well as 3-year median valuation. EV to EBITDA is also near 5-year median and 3-year median. Indo price to sale has also fallen to 1.5, which is similar to its 5-year median valuation. Pearl Global is trading at 1.6 times price to sale. Although it is above the median valuation, but that's because company is growing at much faster rate, and even during this difficult period, company has reported 25% revenue and profit growth in trailing 12 months. And its P/E ratio is very reasonable for the growth company is showing. So clearly the valuations have corrected from last year peak. But are valuations cheap? Not really. But are valuations comfortable to take a contra call? Absolutely. The froth is gone and expectation is more reasonable. Technically, Gokaldas share has crossed 50 DMA and 200 DMA with good volume that shows good strength. But its 50 DMA has not yet crossed 200 DMA. But the recent price volume action suggests that market is expecting a US-India trade deal to happen soon. Indo chart is also similar, with share price crossing 50 DMA and 200 DMA and 50 DMA close to 200 DMA. Pearl Global continued to show strength where its 50 DMA always traded about 200 DMA in last 1 year. So when we put all three companies, Gokaldas Export, Indo and Pearl Global into our 4-point contra investing framework, here is what we get. Fundamentally, all three businesses remain strong. Management is solid, although balance sheet are okayish because textile businesses capex heavy. The issue that caused the correction are largely temporary, mainly the US tariff shock and a short-term global slowdown. These are painful but not structural. The long-term demand story is 100% intact. Global brands are diversifying away from China and Indian textile players are expanding capacity. And the India-UK FTA adds another strong tailwind. That said, the competition is tough from other Asian countries. Valuations have reset meaningfully, not extremely cheap but far more reasonable than last year's peak, making the risk reward far better today. In short, these textile stocks have corrected due to near-term disruption, not because their core business has deteriorated. And whenever the tariff situation normalizes, these companies are well positioned for a strong recovery. As far as institutional confidence is concerned, Gokaldas has 60% holding by FIs and DIs. Indo has also witnessed consistent fall in retail holding and institutions have increased stake. Likewise, institutions are consistently increasing stake in Pearl Global and public holding is reducing. Now you tell me in the comment, what is your take on these US focused textile companies? Are they worth adding at current level or would you like to wait until the US-India trade deal gets resolved? If you find this analysis useful, do share it within your circle and there are many more companies in Contra Investing series pipeline. So stay tuned. I'll see you next video. Till then, take care.